In global financial markets, data isn't just numbers, it's the pulse of the economy. Professional traders and analysts rely on key economic indicators categorized across 7 core pillars to anticipate central bank policies, gauge growth, and position their portfolios. Let's break down each category, the critical data within them, who releases it, and most importantly, how high versus low readings directly move the markets. To master macro market drivers, you need to understand these 7 core categories of economic data. First, track inflation and the labor market to gauge price pressures and employment. Next, follow economic growth and monetary policy to see central bank directions. Finally, keep an eye on business sentiment, housing and trade and commodities. Together, these pillars reveal where the economy stands and where markets are heading next. First up, inflation. Inflation tracks price pressures and purchasing power across the economy. It reveals how fast money is losing buying power, directly influencing interest rate decisions by central banks. To measure this, an inflation gauge tracks the rate of price increases across key goods and services. When demand outpaces supply, price pressures rise across the broader economy, steadily driving up the cost of a typical shopping basket over time. As prices climb, purchasing power declines, meaning you can buy less with the exact same amount of money. Over time, inflation erodes the real value of cash and fixed income savings. That is why inflation data is so critical. It guides central banks in setting interest rates to rein in price spikes and maintain long-term economic stability. Let's look at the key data points in this group. Consumer Price Index, or CPI. Released by the U.S. Bureau of Labor Statistics, it tracks retail price changes in a standard basket of consumer goods. As far as market dynamics of this data is concerned, a cooler CPI moving toward 2% is bullish for stocks and bonds because it signals inflation is under control, reducing the need for high interest rates. Conversely, a hotter CPI pushing toward 4% or beyond hurts stocks and bond prices because it forces central banks to raise rates, increasing corporate borrowing costs and compressing stock valuations. Next data point is the core CPI. This is also released from the Bureau of Labor Statistics. This excludes volatile food and energy sectors to show underlying price trends. Because central bankers view core CPI as the true indicator of sticky inflation, a higher-than-expected core CPI aggressively pushes up short-term treasury yields and the US dollar while slamming tech and growth stocks. A lower-than-expected core CPI gives markets relief, fueling stock rallies. Producer Price Index, or PPI, measures average changes in selling prices received by domestic producers at the wholesale level. PPI acts as an early warning system for CPI. Rising PPI means input costs for factories and suppliers are increasing. Companies will either absorb these costs, reducing profit margins and stock prices, or pass them on to consumers, driving future retail inflation. Falling PPI signals margin expansion and easing price pressures. Personal Consumption Expenditures, or PCE. Released by the Bureau of Economic Analysis, PCE tracks consumer spending behavior, adjusting for product substitution. Core PCE is the Federal Reserve's official inflation target. If core PCE comes in above the Fed's 2% target, it immediately triggers hawkish rate expectations, causing currency pairs like euro-dollar to drop while treasury yields spike. If core PCE trends cleanly down toward 2%, it opens the door for Fed rate cuts, driving broad rallies in risk assets. India CPI. Published by India's National Statistical Office, this measures retail inflation across rural and urban consumer baskets. A CPI reading above the RBI's 6% upper tolerance limit threatens the Indian rupee and triggers bond market sell-offs as traders price in rate hikes. A cool CPI near the 4% midpoint target supports the Nifty 50 and Indian government bonds as interest rate pressure eases. Wholesale Price Index, or WPI. Released by India's Ministry of Commerce and Industry, WPI tracks wholesale level price movements. High WPI compresses corporate profit margins across manufacturing and industrial equities. Low or negative WPI helps corporate profit margins in the short term, but can indicate sluggish industrial demand. Next up, the labor market. This pillar tracks three crucial economic signals: job creation, unemployment, and wage growth. When the market is healthy, more jobs are added, unemployment stays low, and steady wage gains give people more money to spend, boosting overall economic growth. But if the market gets overheated, hiring outpaces worker supply. Very low unemployment and rapid wage hikes increase costs for businesses, which ultimately pushes inflation higher. Understanding this balance is key to anticipating central bank moves and market trends. Let's look at the key data points of the labor market. Non-farm payrolls, or NFP. Published monthly by the Bureau of Labor Statistics, NFP tracks net monthly changes in paid U.S. workers. As far as market dynamics of NFP is concerned, an NFP print well above 250,000 shows a hot economy. While good for growth, it raises concerns that the Fed will raise rates to prevent overheating, which can push the US dollar up and stock futures down. A print below 100,000 raises recession fears, hurting stocks and pushing investors into safe haven assets like gold. An NFP right in the Goldilocks zone of 150,000 to 200,000 is ideal for stock markets. Unemployment rate. This data is also published monthly by the Bureau of Labor Statistics. It measures the percentage of the active labor force seeking work. An unemployment rate holding steady near historical lows of 3.5% to 4% indicates consumer stability and supports earnings. However, a rapid spike above 4.5% or 5% triggers recession indicators like the SARM rule, driving massive sell-offs in stocks and sharp rallies in government bonds as traders price in emergency rate cuts. Jobless claims. Released weekly by the U.S. Department of Labor, initial claims count new individuals filing for unemployment benefits. To speak about the market dynamics, weekly claims jumping above 250,000 indicate accelerating layoffs, weakening the US dollar and lowering bond yields. Claims staying low around 200,000 confirm a resilient labor market, strengthening the dollar. Relative job openings. It measures labor market tightness by tracking open job positions relative to job seekers. To understand the market dynamics, a high JOLTS print with over 1.5 openings per unemployed worker indicates a labor shortage. Companies must raise wages to attract workers, which fuels inflation and leads to hawkish policy. A falling JOLTS number toward 1.0 or lower signals labor supply and demand are rebalancing, easing inflation fears. Average hourly earnings. It measures month-over-month and year-over-year wage growth. To correlate it with market dynamics, wage growth accelerating above 4% annually creates a wage price spiral, where higher pay drives higher consumer prices, which is bad for stocks because central banks respond with rate hikes. Moderating wage growth around 3% to 3.5% preserves consumer purchasing power without stoking inflation, which is ideal for financial markets. Category 3: Economic growth. These metrics measure total health, expansion, and industrial strength, tracking GDP growth, factory output, business investment, and productivity to show how a broadening economy creates jobs, raises incomes, and improves living standards. Let's look at the key data points to track this category of economic growth. Gross domestic product, or GDP. The total monetary value of all goods and services produced, released quarterly by the Bureau of Economic Analysis, or BEA. To understand the impact of it on market, GDP growth coming in between 2% and 3% reflects healthy economic expansion, which boosts corporate earnings, raises stock prices, and strengthens the domestic currency. Negative GDP growth over 2 consecutive quarters defines a technical recession, triggering market downturns, corporate credit downgrades, and capital flights to safety. Retail sales, released by the U.S. Census Bureau. This tracks consumer spending at retail outlets. Since consumer spending drives nearly 70% of the U.S. economy, A strong retail sales print above expectations shows a healthy consumer, boosting retail ETFs and consumer discretionary stocks. A sharp decline in retail sales signals shrinking consumer wallets, dragging down corporate revenue outlooks. Industrial production. Published by the Federal Reserve Board, this tracks output across manufacturing, mining, and utilities. Strong growth in industrial production signals heavy demand for raw materials, driving up industrial stocks and commodities like copper and crude oil. Declining industrial production indicates weakening economic activity and reduced demand for energy and materials. India IIP, or Index of Industrial Production. Released by India's National Statistical Office, this drives sentiment across Indian domestic equity markets. Robust IIP growth above 5% or 6% indicates expanding manufacturing output, driving rallies in the Nifty bank, infrastructure, and capital goods sectors. Weak IIP growth signals industrial stagnation, weighing on domestic stock indices. Category 4: Monetary Policy. Central banks control borrowing costs and financial system liquidity to balance employment and price stability. Key decisions made by the U.S. Federal Reserve. An unexpected rate hike or hawkish policy guidance increases borrowing costs across mortgage, corporate, and consumer debt. This strengthens the U.S. dollar while weighing heavily on global stocks, real estate, and commodities. Conversely, rate cuts or dovish guidance lower the cost of capital, fueling stock market rallies, lowering bond yields, and encouraging economic expansion. In India, monetary policy is set by the Reserve Bank of India's Monetary Policy Committee. A repo rate cut or dovish shift lowers borrowing costs for Indian banks, driving rallies in banking stocks, home loans, and automobile equities. A hawkish rate hike increases loan MIs, depresses credit growth, and compresses domestic market valuations. Category 5: Business Activity and Sentiment. Survey data and PMI charts act as a real-time forward-looking pulse check before official government GDP reports are finalized. By gathering direct feedback from purchasing managers and executives, these sentiment gauges capture shifts in hiring, investment, and demand 3 to 6 months ahead, giving you a crucial edge to anticipate economic turns before hard data confirms them. Purchasing Managers Index, or PMI, published by ISM and S&P Global across manufacturing and services. Remember the threshold. 50.0 is the line between growth and contraction. A PMI rising well above 50 indicates accelerating business activity, driving stock market optimism and higher bond yields. A PMI dropping below 50 indicates sector contraction. If it drops below 45, it signals an impending recession, triggering risk-off sell-offs across equities. Consumer Confidence Index and Michigan Sentiment is an important data to understand business activity and sentiment. These survey indices measure consumer optimism regarding jobs and personal finances. High sentiment scores above 100 mean consumers are willing to make large purchases, which supports consumer stocks. Plunging consumer sentiment warns that households are pulling back on spending, predicting lower earnings for consumer-facing companies. As far as the University of Michigan 5-year inflation expectation is concerned, if long-term inflation expectations rise sharply above 3%, central banks view it as a warning sign and may raise interest rates to keep expectations anchored. The sixth category is housing. Real estate serves as a vital leading economic indicator because home construction ripples directly across manufacturing, employment, and banking. From building materials and trades jobs to mortgage lending, tracking housing starts and home sales reveals key shifts in consumer confidence long before they hit the broader economy, giving investors early clarity on market direction. When the housing market expands, it fuels a powerful wealth effect, boosting consumer spending, corporate earnings, and broader equity bull markets. Conversely, housing downturns have historically triggered some of the worst market crashes in history. The collapse of Japan's real estate bubble in the early 1990s triggered a devastating bear market and decades of economic stagnation. More recently, the 2008 subprime mortgage crisis sparked a global banking meltdown and wiped out over 50% of the S&P 500's value. That is why tracking building permits, housing starts, and mortgage demand is so essential. They offer investors an early, highly reliable look into consumer health, liquidity conditions, and the true direction of the stock market. Finally, Category 7, Trade and Commodities. This final pillar monitors the global flow of goods, services, and capital connecting economies across borders. From shipping containers moving physical products to supply chains delivering raw materials, logistics show us real-time market activity. Meanwhile, price trends in key commodities like oil, gold, and metals reflect global supply, demand, and geopolitical shifts. Tracking what a country imports versus what it exports gives us its trade balance. Whether operating in a surplus or a deficit, this ratio provides a crucial snapshot of national currency strength and global competitiveness. Knowing trade balance is a key data point in this aspect. It measures the difference between a nation's total exports and imports. A widening trade deficit means a country is importing significantly more than it exports, requiring more foreign currency, and putting downward pressure on the domestic currency. A narrowing deficit or expanding surplus adds directly to net GDP and supports currency strength. Next important data point is crude oil inventories. It is released weekly by the U.S. Energy Information Administration, measuring commercial oil stocks. A larger than expected inventory drawdown, for example, less than 5 million barrels, indicates strong energy consumption or tight supply, driving crude oil prices and energy stocks higher. Conversely, a huge inventory build, for example, more than 5 million barrels, signals oversupply or sluggish demand, pulling crude oil prices down and weighing on energy sector equities. Mastering these 7 core categories gives you a powerful macro framework, turning confusing market noise into actionable insights. By knowing how to read these data releases in real time, you stop guessing and start anticipating market moves like a professional trader. If this breakdown brought value to your market analysis, hit that like button and subscribe to the channel with notifications turned on. Now, I want to hear from you. Which of these 7 data categories has the biggest impact on your current trading strategy? Is it the inflation prints or the Federal Reserve's rate decisions? Let me know in the comments below. Thank you for watching, and I'll see you in the next video. Happy exploring!